All right, let's talk investing. So often, it feels like we're just guessing, right? Kind of throwing a dart at a board and just hoping for the best. Well, today, we're going to ditch that whole gut feeling approach. We're going to break down how to look at an investment not as a single all or nothing bet, but as a range of possibilities, and then use that insight to build a much smarter portfolio. Let's get right into it.
So here's the game plan. First, we'll figure out how to calculate the most likely return of a single stock. After that, we'll learn how to measure its risk, what I like to call its wobble. Then we'll take a quick look at you, the investor, before we start combining assets. And that's where we uncover the secret sauce, the real magic of how they all work together. Okay, first up, let's really get our heads around this idea of an expected return. Instead of having just one guess for the future, we need a smarter way to find the single most probable outcome from a whole bunch of possibilities. And this really is the core problem, isn't it? You've got one investment, but the economy could boom, it could stagnate, it could even bust. So where do you put your money when you're facing all that uncertainty? Well, the trick is you don't bet on just one future. You actually account for all of them. So here's how we can start to map this out. We've got 4 different economic scenarios here, everything from high growth down to a decline. And for each one, we've estimated a potential return for our investment. Now, just to keep the math simple for this example, we're saying each of these scenarios has an equal 25% chance of actually happening. The calculation itself is actually pretty elegant and logical. You just take each one of those potential returns, you weigh it by its chance of happening, and then you just add all those little pieces together. It's a way smarter method for finding the average than just adding them up and dividing by 4. And there it is, 6%. Now, the really crucial thing to understand here is that our actual return could be as high as 18.5% or as low as a 6% loss. But our single best, most educated, probability-weighted guess for the future is a 6% return. That's our anchor point. Okay, great. So we've got our destination, that 6% expected return. But that number tells us absolutely nothing about the journey. Is it going to be a smooth, calm ride, or are we strapping in for a roller coaster? To figure that out, we need to be able to measure the potential bumpiness, or the wobble. And in the world of finance, risk is really just a measure of this exact wobble. We quantify it with a couple of key terms, variance and standard deviation. Just think of them as a way to put a number on how wildly the actual returns might swing around our 6% average. Now, the logic here is really important. First, for each scenario, we see how far off it is from our 6% average. Then, we square those differences. This is a super important step because it makes sure the big positive swings and the big negative swings don't just cancel each other out. And finally, we just find the weighted average of all those squared differences. And to get to standard deviation, which is how you'll usually hear risk talked about, you do something really simple. You just take the square root of that variance number we just calculated. That's it. It just translates that squared number back into a percentage that's much easier for us to wrap our heads around. Okay, so we've got the numbers for our investment, but here's the thing. Risk isn't just a number sitting on a spreadsheet. It's also about how you, the person investing the money, feel about that number. Your personal appetite for risk is a massive part of the equation. You basically have 2 main camps. On one side, you have the risk-averse investor. They're the sleep-at-night type. They're all about safety, predictability. They want the smoothest ride possible. But on the other side, you have the risk-seeking investor. They actually thrive on that wobble. They're drawn to volatility because it comes with the chance, even if it's a small one, of a huge payoff. And this quote just nails it, doesn't it? Analyzing the investment is only half the job. The other half is analyzing yourself. Seriously, knowing your own tolerance for risk, understanding at what point that wobbles starts to make you panic is one of the most critical and overlooked skills in all of investing. All right, so we've got a handle on analyzing a single asset. Now let's start combining them. This is the moment we go from just looking at one stock to actually building a portfolio. And trust me, this is where things get really interesting. First off, just a quick definition so we're all on the same page. A portfolio is just a fancy name for all the different investments you own, all grouped together. Think of it like your personal all-star team of stocks, bonds, whatever it might be. Now, here's the easy part. Calculating the expected return of your portfolio is totally straightforward. It's just a weighted average. If, say, 60% of your money is in asset A and 40% is in asset B, your portfolio's return is just 60% of A's return plus 40% of B's. Simple, right? But, and this is a big but, don't get too comfortable. Because while the return calculation is simple addition, the risk calculation holds this powerful, almost magical, counterintuitive secret. This is what we call diversification, and it's the real secret sauce to smart investing. And here it is. Seriously, if you take only one thing away from this whole explainer, let it be this. The total risk of your portfolio is not, I repeat, not just the simple average of the risks of all the things inside it. In fact, it's almost always less. How on earth is that possible? Well, it all comes down to one single word. And that word is correlation. It's just a measure of how two different assets move in relation to each other. Think about an oil drilling company and an airline. When oil prices shoot up, the drilling company does great. But the airline, they get hammered by higher fuel costs. They have a negative correlation. When one zigs, the other one zags.
Covariance and correlation are just the fancy statistical terms for this relationship. This dance between the assets is the whole secret. It's not just the individual riskiness of each investment that matters. It's how they move together, or in opposite directions, that truly defines the risk of your entire portfolio.
Whoa, okay, I know, that's a formula. Don't panic. You do not need to memorize this. Just focus your eyes on that final piece, that covariance term at the end. That is the secret sauce written out in the language of math. It's the part of the formula that accounts for that zigging and zagging. And when assets don't move in perfect lockstep, this term actively reduces the portfolio's total wobble. This is the mathematical proof that you can build a portfolio that is actually safer than the sum of its parts. So, I want to leave you with this question to chew on. This powerful idea of combining things that zig and zag to create more overall stability, it doesn't just apply to stocks and bonds. Think about your career, your skills, maybe even your hobbies. Where could a little bit of diversification, a little negative correlation, make your own life a bit more resilient? Thanks for tuning in.